Hello friends, I'm back with another interesting session. Now in today's session we'll be learning about the computation of opening capital. Now in the previous videos we have learnt about the concept of interest on capital and the provisions which were related to the interest on capital. Now today we'll be learning how we will be computing the opening capital. Now let us understand that what is the amount on which interest on capital is computed. Now interest on capital, when we calculate for a partnership firm on their capital, we calculate on the opening capital, that is the capital that is present at the beginning of the year. Now in addition to that, there is a possibility that during the year some additional capital might have been introduced. So whatever is the additional capital that has been introduced during the year, on that capital also the partners would be entitled to interest on capital from the date it was introduced till the end of the year it was employed in the business. So on that also is entitled. Whereas there is another item like the drawings which is out of the capital. So drawings, as we have already learned in the interest on drawings, there is a separate video on that related to drawings, are of two types: drawings against profit and drawings out of capital. Now when the amount of drawings is made out of the capital, what happens? The capital amount gets reduced. Therefore, from the date when it is withdrawn till the end of the year, the amount of capital was not there in the business. Therefore, the partner will not be entitled to interest for that part of the year when the capital was not there. So we will have to remove the interest on capital calculated on the drawings amount for that particular period. So this is the way we will go and calculate the interest on capital. But for this purpose, we need, first of all, the details will be available about the capital introduced during their drawings against or out of capital. But the information about capital that is available would be basically the closing capital. That is the capital that we get out of the balance sheet. Because balance sheet would be given or capital at the end of the year would have been given. We know balance sheet is prepared as on 31st of March of the year, that is at the end of the year. Suppose it is 2021 April 1st till 31st March 2022 is a financial year. Then the capital that is available in the balance sheet is the balance which is obtained at the end of the year, that is 31st March 2022. But we will not be able to apply the interest on capital percentage on closing capital. We would require the opening capital. Why we cannot apply on the closing capital? Because this closing capital would have been arrived at after all the adjustments. What are the adjustments I'm talking about? The adjustments I'm talking about are not just the additional capital introduced at the drawings of the capital. There are appropriations which are done as per the provisions of the partnership deed. So if interest on capital is allowed, then that is to be given. There will be share of profit given. Interest on drawings will be charged. Remuneration in the form of salary, commission may be given to a partner. So all that would have been passed through the capital account, and then the closing balance is arrived at, which is taken over into the balance sheet. Therefore, we are supposed to adjust the closing capital for these appropriations and these two items of additional capital introduced in drawings out of capital. When we work back the way up, we will be able to arrive at this amount of opening capital. And therefore, in today's session, we will be learning the way we can compute the opening capital. Now, today's session I will be discussing two ways. One is by the capital account method, where we will prepare a capital account. We will feed in the details, whatever is available in the question, and from that we will be able to arrive at the opening balance. Now you know capital is the amount owed by the firm to the partner, so it's a liability of the business in a way. So that is why it would have credit balance. Now other details that are available, as we saw, could be the capital which is introduced during the year, which increases the capital. So it is going to be on the credit side of the capital account that we would be writing it. Other than that, what all can increase the capital? When interest on capital is provided to the partner, it is credited to the capital account. The remuneration in the form of salary and commission will be credited to his capital account. And during the year, if there was profit and there was divisible profit which was distributed to the partners in the profit sharing ratio, that would also come in from the profit and loss appropriation account. So that gets credited here. Other than that, the items that will go on the debit side which would reduce the capital would be your amounts of drawings. The drawings against capital, drawings against profit. Now, other than that, interest might be charged by the firm for the drawings made, which will be calculated on the drawings against profit. So that interest on drawings will be subtracted from the capital. And if in that year there was a divisible loss, there was only loss, net loss available, then the share of the loss would have got debited to the partner's capital account. And we would have from the balance sheet the closing balancing figure here, balance sheet, the capital figure as to balance carried down given here. Now, with these details filled in, we can find out the balancing figure, which would be the balance brought down balancing figure of opening capital. So, by this method, by preparing a capital account, you can find out the opening capital for the computation of interest on capital. The other method is the statement method. Now, suppose there are, as you also know, there are two ways of maintaining the capital. One is a fixed capital method, other one is a fluctuating capital method. So this capital account that I have prepared to you is to show under the fluctuating capital method. So all the appropriations, including the additional capital introduced and drawings against capital, everything goes through the capital account. But if the partnership firm was maintaining capital under fixed capital system, then in the capital account you would have just the closing, the opening, the additional capital introduced and the drawings against capital. What about the rest of the items? These rest of the items related to your interest on capital or remuneration or the share of profit or loss and interest on drawings would be, or the drawings against profit would be going through the current account. Therefore, to find out the opening capital when the capital is fixed, it would be simple. You will be just adjusting the amounts related to capital introduced and drawings against capital. So you will be writing the closing capital, the drawings against capital, and you will be subtracting the capital introduced to arrive at the balancing figure, which would be the opening capital. So this is as simple when you prepare the capital account. Now, using statement method, I will show you how to compute the opening capital. Now, first we will take that this particular firm is maintaining capital under fixed capital system. So here the simple statement would be, we would start with the capital at the end of the year, which comes from the balance sheet, or if they are given capital as on 31st March of that particular year, it means it's a closing capital. So we write that amount here. We just have to add back the drawings against capital, if any, and subtract the additional capital introduced during the year, if any. And that would give us the capital at the beginning of the year, or the opening capital, on which we would calculate the interest on capital. Now, if the same thing, if the partnership firm is maintaining the capital under the fluctuating capital method, then the table would be a little bigger with more amounts, because appropriations have also gone through the capital account. So again, we start with the capital at the end of the year, which was I was calling as closing capital, that comes from the balance sheet as on 31st March at the end of the year. To that we add back the drawings against capital, if any, given, drawings against profit, share of loss, if any, and interest on drawings, if any, has been charged. These were subtracted and arriving at the closing capital, so we are adding those back. And we would be subtracting certain items like the additional capital which were introduced during the year, if any, the salary or commission to partner, the interest on capital which is allowed to the partner, and the share of profit, if any, for the year. All these were added to the opening capital to arrive at the closing capital. That is why we are subtracting it, we are removing it out. And once we do that, what amount we arrive at is called as the opening capital. So we apply the interest on capital percentage on this amount arrived at. So in this way, through table method, you can very easily calculate the opening capital. So this was the theory part. Now let us apply this concept using a practical question. So here I have given you a question which I will be working out for you to understand this method. Sonu was a partner in a partnership business. He had capital at the end of the year 10 lakh. So this is the capital at the end, rupees 10 lakh. Drawings during the year were 1 lakh. So here, what type of drawings is this? Nothing has been specified. So when they have given drawings, normally when it is out of capital, they would specify that this is drawings against capital. Here, nothing has been specified. So we will assume that this is drawings against profit. So drawings against profit while computing the opening capital. Further, he introduced additional capital of 1,50,000 during the year. This was a capital introduced. Other than that, they've given interest on capital credited to his capital account was 25,000 and the interest on drawings debited to his capital account was 1,50,000. And his share of profit which is credited to his account is 1 lakh. Now let us solve this under all those two methods. First case, the capital account is prepared. So in that case, we will start with the amount given here, going to that format. Here they have given the closing capital as 10 lakh rupees. Then we saw there was a drawings of rupees 1 lakh. This I assumed it was drawings against profit and I put it here. There is no drawings against capital given here. Other than that, if you see, we have additional capital introduced of 1,50,000 and interest on capital of 25, interest on drawing of 15. So let us go back to that. So we have additional capital introduced here, interest on capital and interest on drawings. There is no share of loss here. So going back, let us get these amounts. 1,50,000 additional capital introduced. So 1,50,000. Then there was interest on capital which was 25,000. So interest on capital was 25,000 and there was interest on drawings of 15,000. And there was no other information available. That's it. There was a share of profit of 1 lakh. So during the year there was a profit. So that got credited here, 1 lakh. That's it. No commission or remuneration to partner. As per this solution, total it up. 11,15,000 is the total. Write it on the other side. 11,15,000. Now subtract these amounts. So it would be 7 11,15,000. We'll subtract the amount of 1,50,000. We'll subtract the amount of 25,000 and we'll subtract the amount of 1 lakh. That yields us an amount of 8,40,000. So that 8,40,000 is a balancing figure. So this is the amount of opening capital, the balancing figure we arrived at using the partner's capital account. I hope that is clear with the capital account. Now, if we use this particular statement method. So now if we suppose they have followed the fixed capital system, then only thing that would come is the capital at the end of the year. There were no drawings against capital because we assumed in that example it was drawings against profit. There was only additional capital which was introduced, which we would subtract. So we subtract this, we get 8,50,000 as the capital at the beginning of the year. So using, if they were following fixed capital system, this would have been the amount of opening capital. But if they were following fluctuating method, then we start with the opening capital of 10 lakh. Now we don't have any drawings against capital. We do have drawings against profit of 1 lakh. So we write it here, 1 lakh. There is no share of loss. There was interest on drawing of 15,000. there was additional capital introduced, which was 1,50,000 and interest on capital of 25. So we go here, additional capital introduced was 1,50,000 and the interest on capital of 25,000. And there was also share of profit of 1 lakh. So we write it here under the subtract. So this way we just total up these drawings against profit and interest on drawings. It comes to 1,15,000. So that yields us 11,15,000. And we are supposed to subtract here 75, 2,75,000. So now we again calculate. It is 11,15,000 minus 2,75,000. So that gives us 8,40,000. So this is the amount of opening capital. If you see under the statement method, in fluctuating capital and under the partner's capital, we get the same amount of opening capital. So this is how you compute the opening capital. Now basically, if it is fixed capital system, they would have specified that the fixed capitals of the partners were so and so, and then you could have used this method. I just showed you that if it were fixed capital, then only these items would have come into picture in the computation of opening capital. So that's it, friend. It is as simple as that. I hope you have understood how to compute interest on capital. You can use any of the method with which you are comfortable. So that's it for today. I hope this session was useful to you. If you found this video useful, please do like and share it. And if you have not yet subscribed to my channel, please do subscribe to the channel and help you and let us grow together. So thank you. Have a great day.